Many of the wealthiest real estate investors in the world don't spend their time buying houses. Instead, they focus on something very different: income-producing buildings, shopping centers, warehouses, apartment complexes, and the reason has nothing to do with size. It has everything to do with income. Because commercial real estate isn't really about owning property, it's about controlling the cash flow that property produces. And once you understand that shift, real estate stops looking like a place to live and starts looking like a financial system. But to understand why experienced investors think this way, we first need to understand how commercial real estate actually works. When most people hear the phrase commercial real estate, they immediately picture large office towers in downtown financial districts. But commercial property is actually much broader and much simpler than that. At its core, commercial real estate is any property designed to generate business income. Most investments fall into four major categories: office buildings where companies rent workspace, retail centers where businesses operate storefronts, industrial properties like warehouses and distribution centers, and multifamily apartment buildings with 5 or more residential units. For example, imagine a small neighborhood retail plaza with a coffee shop, a dentist, and a gym. To most people, it's simply another building, but to an investor, it's a collection of leases that produce predictable monthly income. And this is where commercial real estate becomes very different from residential real estate, because houses are usually valued based on comparable sales. Commercial properties are valued based on income. Now, this is where things get interesting. The easiest way to understand commercial real estate is to think of a property as a small business. Imagine a large box. Inside that box are multiple tenants. Each tenant rents space and pays rent every month. Now imagine all of that rent flowing into a single bucket. That bucket represents the property's total income. But the owner doesn't keep everything in the bucket. From that income, they must still pay expenses such as property taxes, insurance, maintenance, repairs, utilities, and sometimes professional management. After all those costs are paid, the remaining income is called net operating income, often shortened to NOI. And this number represents the true earning power of the property. Now, here's the part many beginners don't realize. In commercial real estate, income directly influences property value. Let's walk through a simple example. Imagine a retail center producing $500,000 per year in net operating income. Investors use something called a cap rate to estimate what that income stream is worth. Think of the cap rate as the return investors expect for owning that type of property. If similar properties in the market trade at an 8% cap rate, that building might be worth around $6.25 million. But now imagine the owner improves the property. Maybe rents increase slightly, maybe a vacant unit is leased, or operating expenses are reduced. Now the building produces $600,000 per year instead. Same building, same location, but suddenly the property may be worth more than $7 million, which means over $1 million of value was created simply by improving the income of the property. Now this is where the strategy changes. Many experienced investors prefer commercial real estate for 3 major reasons. First, commercial leases are usually much longer. Residential tenants often sign 1-year leases, but commercial tenants frequently sign leases lasting 5, 7, or even 10 years, which creates far more predictable income. Second, commercial real estate is far more scalable. Managing 50 houses scattered across a city can become extremely complicated, but managing 50 units inside a single apartment building is much more efficient because everything is centralized. Maintenance, operations, and management become easier to organize. And the third reason is something many beginners overlook. Certain commercial leases transfer major expenses to the tenant. These agreements are called triple net leases, often shortened to NNN leases. In a triple net lease, tenants are responsible for paying 3 major expenses: property taxes, insurance, and maintenance. Instead of the landlord paying those costs, the tenant covers them directly. For example, many national retail chains operate under long-term triple net leases, where the business maintains the building and pays most of the property expenses, while the property owner primarily collects rent. This structure can make certain commercial properties easier to manage than residential rentals. But commercial real estate is not automatically passive. It's still a business. And like any business, risk matters. Tenant quality matters. Management matters. Vacancy matters. If tenants leave, income drops. And when income drops, property value can drop as well. Banks understand this clearly. When lenders evaluate commercial deals, they look closely at something called the debt service coverage ratio, or DSCR. This metric compares the property's income to its loan payments. In simple terms, lenders want to know one thing: does this building produce enough income to comfortably pay its debt? If the answer is yes, financing becomes easier. If the answer is no, the deal may never be approved. Now let's talk about something many beginners never see behind the scenes: how professional investors structure ownership. Imagine 3 boxes stacked on top of each other. At the bottom is the property LLC. This company owns the building itself. If something happens at the property level, such as lawsuits or tenant disputes, the liability usually stays inside that LLC. Above that is the holding company. Think of it like an umbrella that owns multiple property LLCs and collects income from several properties. And finally, at the top of the structure is the investor, the owner. But here's something many beginners misunderstand. Commercial real estate investing usually isn't about chasing fast appreciation. Professional investors focus on something much simpler: buying income, improving operations, using conservative leverage, and reinvesting profits over time. Think of each commercial property as an income engine. One building produces cash flow. That cash flow helps fund the next investment, which produces more income, which funds the next acquisition. Over time, this creates a compounding system where investors gradually build portfolios of income-producing assets. At the beginning, most people think real estate investing is about owning buildings, but experienced investors see something very different. They aren't really buying buildings, they're buying income streams, and the building is simply the container that produces that income. So the next time you drive past a shopping center, an apartment complex, or an office building, don't just see the building. Try to imagine the income flowing through it, because that's exactly what experienced investors are looking at: an income machine. And if you want to learn how commercial real estate really works, not the hype, but the actual systems investors use, then consider subscribing to the channel. Each week, we break down the concepts behind commercial real estate investing so you can understand how professional investors analyze deals, manage risk, and build long-term income through property. And if you found this video helpful, give it a like. It helps more people discover the channel and learn how this business actually works. I'll see you in the next video.